December trade starts off sloppy. Well, that was just what we expected. That's coming up on 3 Minutes on Markets and Money. A couple of weeks ago, we laid out the premise for the month of December, saying that the first couple of weeks of December tend to be a bit sloppy in terms of trade, and that's because of mutual fund distributions and other things that are going on in the markets as we start to get into the end of the year, tax loss harvesting, etc., weighing on asset prices. That's exactly what's been happening over here for the last couple of days in particular. Yesterday, of course, markets declined a bit more, sitting right on top of the 100-day moving average right now, holding that support momentarily. But again, this kind of action, very typical of this time of the year, that typically sets up that end of the year Santa Claus rally. Now, will we get a Santa Claus rally this year? Well, maybe. It's never guaranteed, but you do have year-end portfolio window dressing by big mutual funds, hedge funds, etc. for that year-end reporting. They want to make sure and have all the right assets on their books, not have too much cash for billing purposes, etc. So again, that's why you typically get a little bit of that push right into year-end. So again, this sloppiness, very much expected, but as we've talked about before, really we are just confined within this very tight trading range now for the last several weeks. Markets really haven't gone anywhere after this initial rise off the lows of the markets back in September. Back in September, right at the end of the month, we wrote this article called "A Big Short Squeeze is Coming," and that's exactly what we've seen here over the last really 4, 5, 6 weeks. Now, of course, markets challenging that support line at the 100-day moving average. Below that, we've also got the 50 days. So again, downside is somewhat limited at the moment, but that could change depending on what the Federal Reserve says next week. That FOMC meeting next Wednesday when they hike rates by 50 basis points. Don't be surprised if Jerome Powell comes out with a much more hawkish statement than what he did recently at the Brookings Institution, because he did not like that big spike in the market on this idea that a pivot was coming. I think he's going to be a little bit more hawkish here. That could suppress prices a bit more. But again, as we just kind of continue to work through this, we could have some more downside in the markets near term. So again, just be a little bit cautious here. Use this rally that we've had to reduce risk, rebalance your portfolio, do your tax loss harvesting for year end. Do that now, because again, we are on a sell signal here short term, which could lead to a bit more sloppy price action as we head towards that end of the year period. We'll keep you updated right here, of course, as always, on 3 Minutes on Markets and Money. We'll see you back here tomorrow.